So what does BlackRock think about the present and the future of sustainable finance and ESG? Here to talk about that are two of its principals. Jessica Tan is the Global Head of Corporate Strategy, and Mark Wiedman is the Head of International and Corporate Strategy at BlackRock. Welcome to you both.
Thank you so much for having us. It's a great
really
pleasure.
Excited to have you here. When you view, Mark, let's start with you. When you view the landscape where we are in this moment of ESG and sustainable finance, what are you seeing? Where are we right now?
So I think we're at a fundamental reshaping of finance. We see at BlackRock, we see the shift in investor preferences and opportunities and risks, risk management perspectives, as being at the same level of change as we saw with the rise of securitization in the 80s and 90s. And then also, actually, I would say the rise of indexing during that same period. We think it's going to fundamentally alter all elements of finance, and it's going to fundamentally reshape portfolios. We also think we're in very early stages of this journey. We've seen incredible adoption by clients around the world. From 10 billion to 100 billion of dedicated sustainable ETFs. But we're just in early days because there's many trillions of dollars of capital that need to flow to reflect, even just taking the climate revolution, just simply the world's responding to that. And that's not even considering many of the other areas that investors are focused on for ESG concerns.
So we're in early days, but one of the things that we're looking at, particularly in Europe, is the regulatory environment, the SFDR, the Sustainable Finance Disclosure Regulation, if I got that correct. Are you seeing, what's the role that's going to play, and are we going to be seeing things like that, Mark, in the US?
So SFDR is, we think, an accelerant of a landscape that would otherwise still move in the same direction. What it basically does is require asset managers to classify the funds they provide into three basic categories. And for simple purposes, it's regular stuff, not sustainable, sustainably oriented, and impact. Use those as your catchphrases. And what we're going to see, and this is the important thing the regulation is achieving, is that it's going to catalyze many buyers shifting to only buying or predominantly buying products that fit those last two categories, being sustainably oriented or impact strategies. And that's going to move a lot of money. There's going to be most dramatic in Northern Europe, where wealth organizations as a set are actually saying that in a couple of years, they're going to stop selling the Article 6 products, meaning the traditional products. So that's going to move a lot of money. But it's not just the regulation, it's the broader client consciousness, because the regulation doesn't force that change, it just actually, let's say, clarifies it or accelerates it. In the US, we don't have a regulatory framework like that. I would put down a pretty big bet, Joel, unless you're willing to take the other side of it. I think this is some pretty easy money, that the SEC is going to follow through with a similar regime in the very near future. And we think that will be very constructive for creating simple, clear labeling rules and allowing clients to make their decisions about where they want to invest. For our view is, it's the client's choice. We advise clients to steer towards sustainable products as our default position, but we think in the end, it really is going to work fastest and best if it's their decision.
I was going to ask you about the Biden administration and your hopes for that, Jessica. In terms of should it lead, follow, or get out of the way here, it sounds like you're hoping it will lead.
Yeah, I think that's absolutely right. Look, I'm hopeful about the administration. I think it's wonderful that there are explicit climate-related policies. In the American Jobs Plan, as those on this call will know, $1 trillion out of the two is dedicated to moving climate forward, right? How do we shift from today to get to a net zero world by 2050? So I'm hopeful about the policy around electric vehicles, charging stations, research, of course. At the same time, what it also points out is, I think the estimates currently are to transition from today to a net zero world by 2050. There's actually a $50 trillion investment need. So what that points to us is that there's still this large gap to get from here to there. And so I also think that there's a role for private sector. In fact, that's what clients want to talk to us all the time about, right? What is this investment opportunity as the world inevitably transitions? I'm also hopeful beyond the infrastructure plan, all the things that Mark was talking about, right? If we actually get to a more globally consistent framework, that's the real way we're going to see capital move to follow the investment needs, because requirements will be clearer, product labeling will be clearer, and that's how capital is going to move in masses.
And Joel, can I add to that just a second about what we hope to see from the administration? Building on what Jessica just said, a few very specific things. The first is that we are seeking a single global standard for disclosures, especially around climate and carbon-related issues and emissions. So that is number one on our list. We want a single global standard. It's the top priority we get from CFOs and CEOs around the world, and from asset managers who are our clients. Can you give us one clear thing we're supposed to fill out? The second thing is that from the financial regulators as a set, including the banks, the bank regulators, they need to actually have consistency across securities and bank and insurance, ultimately insurance, although the federal government doesn't regulate insurance, the balance sheets and how those, so we have similar accounting effectively across these. And then the last thing is, importantly, we have to not forget about the private market. The private market, which is funded chiefly by banks, it is not large, we're as a relatively small part of our business, is critically important to have the same level of disclosure. And the reason why, Joel, is the world doesn't get better if public companies dump dirty assets into private pools of capital, which then disappear from public disclosure. That does not make the world better. But it is what will be the outcome if we don't have consistency across the whole platform. And then the last thing in terms of actual economic policy, we're extremely excited about the infrastructure oriented climate pieces is getting the US moving in an area where we have chronically underinvested. But I think ultimately, without change in incentive structures for private actors, some form of pricing around carbon on a global basis, or at least among the developed countries, it's going to be difficult to trigger the capital shift of the scale that Jessica's talking about, because if externalities aren't priced in, even good actors can reach challenging decisions between different stakeholders as opposed to aligning them under a clear incentive regime.
Well, that's a pretty big agenda to take on. But Jessica, I want to go back to something you said. You said that one of the big questions companies are asking BlackRock is, what's the opportunity here for them? What do you tell them?
Yeah, for us, we think the shift at the reallocation of capital in this direction it's real and it's going to accelerate. So for us, it's absolutely a historic investment opportunity. Just thinking about the amount of momentum that first, when you look at all of the government commitments, right, that are made around the world about transitioning economies to be net zero, when you think about the corporate commitments that folks are making. And with that change of action, money gets reallocated. And anytime that happens, there are going to be differences in the financial markets. There'll be winners and losers. And what we believe is that companies that are well-positioned and well-prepared for the transition are going to get rewarded. Those who are leaders are going to get rewarded. And those who are struggling to transition, will be less rewarded by the financial markets. So for us, trying to understand from clients, from companies in which we invest, their overall strategies and how they're positioned for the energy transition is a critical part of our fiduciary duty. It's about returns for us. It's about investment risk. It's about understanding how prepared these investments are for the overall transition.
Yeah, and increasingly, it's about making sure that we're looking at the ecosystems that serve business. Close to between a third and half of global GDP comes from ecosystem services. Mark, last month, I believe BlackRock said it would start pressing companies on their natural capital disclosures and other things. What's behind that?
So I'm going to invite my partner to take this one on.
Sure. Natural capital is an investment issue for us, right? So we issued a paper out of our stewardship team just on why we're focused on natural capital in our conversations with the companies in which we invest on behalf of our clients. And for us, companies that manage natural capital well, it's a signal that there are proper controls, governance in place. And if you don't manage natural capital well, it often exposes you to operational or potentially litigation risk. And so for us, it all flows back to our fiduciary duty. We want to make sure that if a company is exposed to a risk, right, whether it's reputational, litigation, or future, that we're understanding that. And in today's environment, especially with data getting better, expectations becoming clearer, we also wanted to articulate what we expect from our companies in terms of managing natural capital responsibly, disclosing responsibly, and how they communicate what they're planning on doing with us.
Do you have a sense that companies are ready, willing, and able to do that?
Yeah, look, some are certainly more advanced than others, which is why we think it was important for us to lay out expectations. We don't tell companies what to do. We don't see that as part of our job. But what we can say is, this is what we see as best practices for disclosures. This is what we see as best practices for, operations and governance.
Late last year, BlackRock published its first ever global sustainable investing survey. And one of the things you said coming out of that is that the pandemic would accelerate sustainable finance. Why is that? And is it happening, Mark?
So what we found in our survey when we talked to clients around the world is they had increased their interest in sustainable strategies over the past year. And remember, at the beginning of the pandemic, there was a lot of tut-tutting from critics of sustainable investing, basically saying, like, your luxury times are over, people, and you guys should just give up on your dream and focus. Now we can't afford these luxuries. And that's exactly the opposite of what actually happened. Clients around the world, and I mean around the world, in every single market, have moved sustainable investing to the number one or number two concern that they have on their priorities when they talk with us. And so that has, why is that happening? Well, I think the first thing is these are trends that were already underway. We were already seeing big growth in 2018 and 2019. 2020 was a big step change, but it was a continuing a direction we already were seeing. But I think, this may sound slightly mystical, Joel, but I think that the pandemic made everyone slightly more conscious that actually this is only one planet we live on, and we are all far more vulnerable than we seem or may think day to day. And so that consciousness changed. It's a global problem, the pandemic. Well, many of the issues, particularly around climate change, are also global problems. And so I think that helped. And then this also helps. If you've invested in sustainable strategies in 2020 and you shorted traditional strategies, you made a bundle. So that helps to get people's interest going as well. We just launched two strategies, two products, which we think are super exciting, but they show bookends of where clients are. On the one end, we just launched the biggest ETF. It's actually two ETFs together that give you a low carbon transition path. And it's funded by a set of really big institutions, including CalSTRS in California, but also Temasek, the sovereign wealth fund, a pension plan in Finland, like a diverse group globally, coming together and saying, we want to make a huge splash to attract other capital to accelerate that transition. That's really cool. That's on the ETF side. Way on the other side, we've just launched our first venture capital and growth equity strategy period ever. And it's focused on decarbonization technologies. And that's also going to be in a joint venture with that sovereign wealth fund, Temasek, which has put a commitment of putting many billions to work in this area. So why is that happening? And the answer is people feel it aligns with their mission. But importantly, we really do think there's a lot of money to be made for clients, that if they get ahead of these trends and they invest in them, that this trend of shift doesn't mean that every sustainable product is a good product. It means the trend is. In the same way that in the 1980s, securitization and indexing were things that the earlier adopters actually managed to achieve their financial objectives faster than people who didn't.
Joel, if I could add one other thing, just in terms of the pandemic and why we think sustainability took off so much. In addition to all of these, climate and kind of the pandemic seeming sort of existential, right? Well, first of all, there are these climate events all around the world that seem to be happening with more frequency: bushfires, forest fires, Arctic fires, all of this. And at the same time, I think the pandemic highlighted certain inequities that exist in the overall system. And so, what we saw was a greater interest in social impact. And so it highlighted the broader topic of, ESG, which then, of course, relates back to climate in so many ways, and they're becoming so inextricably linked. So for all this almost like strange confluence of factors, that was 2020. I would say, at least from my perspective, interest in sustainability accelerated much faster than I'd anticipated at the beginning of the year.
Yeah. Well, let's talk about the products for a second, because BlackRock, like pretty much every other financial and investment firm, has launched a number of ETFs, as Mark was saying, and other investment vehicles around ESG and sustainability. And as Morningstar recently found that, at least looking at European funds of that sort, that they were outperforming non-ESG funds over 3, 5, and 10 years. Jessica, I'm wondering what would happen if that changed, if all of a sudden those funds started underperforming the market. What would happen to BlackRock's approach, strategy, and commitment?
Sure. Look, we are fiduciaries for our clients first, and we have a long-term outlook. And for us, this is a secular trend, right? So money is really allocating over the long term and the long period. So we believe that this trend is here to stay. Of course, over any certain time period, we're going to get variances. However, Mark already mentioned the outperformance in 2020. I think if you were to look at that, as a calendar year, 80% of sustainable strategies outperform traditional benchmarks. We've done some back tests across other periods of market downturns, and sustainability has proven to be more resilient. These are still short data sets. However, we believe through the long run, this trend will be persistent. And with each kind of cycle that we see outperformance, questioning kind of, do you have to give up value to invest sustainability? We think that those questions will start to dissipate.
Yeah, and Joel, can I just say, I actually find there's a lot of critics of sustainable investing get very focused on micro differences in performance. And I actually think we live in a world where you can't really explain why people own US Treasuries in their portfolios, given that they're negative yielding in real terms. And people get very focused on these micro questions around sustainable strategies and don't focus on huge questions like, should you even own sovereign debt, period? And I think we have to put it in context. What are we claiming? We believe that sustainable strategies will deliver better risk-adjusted long-term returns. We are not promising you'll make a bundle tomorrow. And so it is a long-term perspective that having a broader view of risk will lead to longer returns. We're pretty confident of that. Frankly, more confident we are than the outlook on treasuries or Japanese equities or whatever else.
Yeah. One final question to you both. BlackRock is set itself, as I said, a leader in all of this, placed itself in the center of the universe for willingly or not. But it's also become a lightning rod for critics in general who look at again, micro issues and may see some ways that you're not necessarily walking your talk. I'm wondering how you respond to that. And is this sort of what I call the tyranny of brand leadership, where only the biggest and best known brands get attacked? Or is there something more valid around this in terms of just how you're still trying to move this big ship? Jessica, we'll start with you.
Yeah, sure. Yes, sometimes if you're more in the spotlight, you're held to a higher standard. In a lot of ways, we welcome that, right? We are glad that people would hold our funds and their labeling to the highest standard, because that's also where we want to be. We are glad that we are out there and being known as a thought leader. We know that comes with also a different layer of scrutiny. But we think that we welcome that this is the age that we live in.
So Joel, I applaud, echo, and embrace what Jessica just said. If you're going to be the leader, you should expect to be held up to higher standards, and that's life. The one thing that I think some of our critics perhaps could just study a little carefully is it's not our money. So we can guide clients, we can advise clients to take sustainable strategies, but for clients who want a traditional strategy or simply want broad exposure to the whole market, which is where a bulk of our assets lie, in broad index strategies. I would ask our critics to understand the goal is to convince our clients, which we are working hard on, to help accelerate the transition to a net zero world, to making a more just and inclusive capitalism. But we have to work with our clients. It's not our money. We can advise, we can nudge, we can help. but we can't actually just decide. And that's a difference between us and the banks. The asset management industry, not just BlackRock, we serve our clients as agents. It's not our money, which is not to say that we don't have a responsibility to help guide and push. But in the end, we have to serve our clients as fiduciaries on the demands, the mandates that they call out. So we need the whole society to be shifting, and we're being loud. Just recognize that is a limit on where we can go, and have a sense of humor with us as the whole real economy, of which we are only a reflection, is shifting.
Yeah. Well, by virtue of your size, your leadership, and your voice, you are the leader in this space. And everybody, I think, follows what BlackRock is doing and saying, and hopefully those two align on a regular basis. But I want to thank you for your leadership, and thank you so much for sharing with the GreenFin audience. Mark Wiedman and Jessica Tan. Thanks.
Thank you so much.
Thank you for having us.
Goodbye now.